In this video, we are going to be very practical. I will show you what people actually buy when they buy bonds, how returns really show up, how government and corporate bonds differ, and how inflation and taxes change the picture. Most individuals don't buy individual bonds directly. They buy ETFs that hold bonds, because individual bonds require large minimum amounts, they expire at specific dates, and they need to be constantly reinvested. ETFs solve that because they hold thousands of bonds. They roll them over automatically, and they trade like a stock. So you buy one ticker, but you get exposure to the entire bond market. Let's start with government bonds. In the USA, popular examples are US Treasury bond ETFs. They can be short-term, intermediate, or long-term maturities, which is how many years basically the bond lasts. These ETFs, they hold bonds that are issued by the US government, whereas in Europe, you see Eurozone government bond ETFs, which can be German, French, Italian, or they can be a mixture of all. And the key difference is not safety, but more currency risk, inflation history, and yield levels. And historically, the US bonds offer higher yields, higher inflation risk, and also higher currency volatility for EU investors. EU bonds, on the other hand, offer lower yields, but also lower volatility. And often, this means negative or near zero real returns, especially during high inflation periods. Let's look at how these ETFs work now, because it is important. If you recall from the previous video, returns come from two sources. Dividends, which is whether they are accumulating or distributed, or price changes, when the interest rates change, for example. When rates go up, we see existing bonds become less attractive. And so bond prices fall, and obviously the ETFs go down as well, because they only hold these bonds. However, when rates fall, all the bonds with higher yield, or coupons as they're called, become more valuable. So bond prices increase, and the ETFs go up. This is why bond ETFs can lose money if even nothing defaults. But let's add corporate bonds now. These ETFs hold debt that is issued by companies, not governments. Some examples are investment-grade corporate bond ETFs, which can be also high-yield or junk bond ETFs. So when you hear high yield, it mostly means lower credit quality, and they are often called junk. Corporate bonds offer naturally higher yields because we have higher risk, and we also have exposure to business cycles. So in simple terms, government bonds depend on state credibility and inflation. Corporate bonds depend on company profits and balance sheets. And so during economic stress, corporate bond prices usually fall much more than government bonds, because there is a real risk of bankruptcy. That's the trade-off. Here's the part that many people miss. Bonds are fixed promises. If inflation rises, the real value of future payments falls, even if the bond pays exactly as promised. That is why periods of high inflation are very dangerous for bonds. We have had fairly high inflation rates recently, 3, 4, even 5%. Imagine you receive 3% return from bonds. On paper, digital paper from your broker, you are up. You are doing great. But in reality, you have lost purchasing power. Some ETFs try to address this with inflation-linked bonds or shorter maturities that reset faster. But there is no magic solution. Inflation is the tax that bonds cannot escape. Returns are heavily affected by taxation. Interest payments are usually taxed as income, not capital gains. That means higher tax, less compounding, and lower real returns after inflation. In contrast, stock returns often benefit from capital gains taxation or tax deferral. So bonds look safe on paper, but can be surprisingly weak after taxes. Imagine that you have 50,000 invested in a government bond ETF with a 3% yield. Inflation is 4% and tax on income is 10%. So with 3% yield, you earn 1,500 as income over the year. Then comes tax, which is 10%, so minus 150, and you keep 1,350. So on paper you now have 51,350. Awesome, right? But we aren't done. 4% inflation on the original 50,000 means that the purchasing power of your money fell by 2,000, even though your account balance went up by the 1,350. Your money lost 2,000 in real value. And to really drive this home, your result is roughly 1,350 gained minus the 2,000 that is lost to inflation. That means that you're actually 650 USD or euro worse off in purchasing power. So you're basically negative in real terms, even though the bond paid exactly as promised. Now imagine a corporate bond ETF which has a 5% return. It also has higher income but higher risk and is still taxed. So the choice is not about safety, it's really about what risk you're trying to take or are ready to take, rather. So by now we know that bonds are not going to help us get rich. They are about stability, about predictability and time management. They help reduce volatility, they match the future obligations, and it's a good way to park capital temporarily. So when people treat bonds as safe investments, without context, they misunderstand their role. Remember, they are tools, not guarantees. So in practice, bonds are traded through ETFs, influenced by interest rates heavily. They are eroded by inflation and are basically shaped by taxes and balance between governments and corporate risk. So they reward patience and they definitely punish complacency. And whether they belong in a portfolio, it truly depends entirely on why the money exists in the first place.